Hi, I'm Mariana Valley from Debtwire, and with me I have Mark Bulmer from Nordic Capital. Mark, so we just had this really interesting discussion on financing and what's going on with the market. What are the main ideas that you think we got from the discussion?
Well, I think we all concluded that the debt markets are getting more and more aggressive, and that's happened much more quickly than everybody anticipated. And there doesn't seem to be any stop to that in the immediate future. We think leverage levels are going to carry on creeping upwards, and pricing is going to carry on creeping downwards.
And what sort of debt structures are we going to be seeing?
Well, I think we'll see in a number of deals continued structures as we've seen before, but I think there's a new advent in the market, which is that of the local high yield bond, which is really starting to gather a bit of pace now. It's slightly smaller in size and slightly shorter in duration than the international markets, but as the market up here matures, I'm sure that will change.
And how low can we go when it comes to high yield bonds then?
Up here, I think you could probably do something in the region of 50 million euros, and you could probably go up to, well, I should say 500 million SEK, and I think you can go up to about 3 billion SEK potentially. But again, the other difference is that it's only been in the senior secured space rather than the unsecured space so far.
And in terms of the margins on high yield bonds, I think we were talking about sort of 8%.
Yeah, I think it depends. Senior secured, I think, is tighter than that, around the 7.5 space, depending on the leverage point. And the unsecureds, I think, in Europe are trading sort of in the high 8s, low 9s, something like that. So the pricing is very good just now.
So I guess that creates a lot of opportunities for the likes of Nordic Capital.
Absolutely. If you can get cheaper debt, longer maturity, and no covenants, that's obviously much more preferable than not.
So it's really a market for the sponsors at the moment.
I think that's going to be one big area. I also think that corporates may take advantage of it as well. I think maturity is less of an issue for corporates, and if they can disintermediate the banks to get a better deal, I think they will carry on doing that. So.
And in terms of leverage levels, are we going to keep on the sort of 6.5, 7 times range, or?
I think if you look in the Nordic market, you're kind of, you might get a little bit above that, but to get above that you're probably talking PIK notes rather than cash pay debt, I think, but that is starting, as we know, as well. I think traditionally here there's been a lot more amortizing debt, so that naturally limits the total amount of leverage you can put on a deal, so perhaps a little more than in the rest of Europe.
But maybe we could see more bullet-only deals in the region as well?
I think yes, if you use the bond market, if the local bond market. If you're using the local banks, I think they always want to have, typically it's been about a third in an amortizing structure, so I think it'll be hard for them to move away from that very quickly.
Great, well that's really good. Thank you very much, Mark.
Thank you.